Welcome to the Financial Freedom Classroom for January 15th, 2015. Before we get going, we just need to remind you that we're not licensed financial advisors, accountants, lawyers, or tax preparers. Therefore, the information in this presentation is no substitute for legal, professional, financial, or tax advice. It's merely our opinions as somebody who's been through the process, and also be aware that different people have different requirements and situations, and this presentation is for general information only.
And so I'm Sherry, and John obviously is with me, and we are the Financial Freedom Classroom. We are owner and operator of Lock In Your Success, a stock options trading, coaching, and education firm. And just our background a little bit is that we've managed many successful businesses and owned in various industries. We are active real estate investors, and we provide loans and guidance to small businesses as well. And tonight we're going to talk about where are your eggs? So where do you put your money, your asset allocation? And just as a reminder, we are 3 months exactly to tax day. So April 15th is coming quickly. And next week, just as a quick update, we are going to have a CPA, good friend of ours, Kim Landry from Landry and Associates, who's going to be coming on to talk about taxes. So if you have any questions about that topic, please email me or John. Actually, you can email questions at financialfreedomclassroom.com, and we can add those to the presentation.
Right, we'll see if we can get everything answered for you guys.
Right.
So today we are talking about asset allocation, and one of the first things I want to talk about is before you start spreading your assets around, to actually make sure that you have some. So we want to think about first things first, and I'm hoping a lot of you are already to this point, but I'm going to go over it anyway just in case you're not. So the first thing we want to do is we always want to have an emergency fund, and typically at a minimum of 1 month's total expenses, and that would be like a minimal fund. From there, what we want to do is we want to pile in and try and pay off all of our debts. And when I say all the debts, I mean pretty much all debts, with the exception of maybe low-interest loans on appreciating assets. And if you have car debts, credit cards, school loans, all that stuff should be paid down. And at that same time, we need to start building our 6 months' worth of total expenses for what we call a full emergency fund. From there, once that's accomplished, and only after that's accomplished, are you actually at the point where you can actually afford to start looking at investments? You have any comments on that?
Well, I think that the emergency fund thing is very, very important, because for me it would be hard to imagine that if you had an emergency come up, you'd end up actually piling on more debt, because you might have to take a cash advance on your credit card or pay something that you're not necessarily going to be able to pay off with a credit card. So it is critically important to get that emergency fund so that you don't go further into debt.
Right, exactly. And that's, it should be just cash sitting aside. So from there, once we build that, we can start looking at doing some other investments and start putting money towards, I generally recommend put 15% of your income towards retirement, and or whatever the maximum amount is allowed by law. I mean, if you have a very high income, 15% may be over the maximum amount, but for most people, they can probably put 15% in.
Well, as a quick side note to that, I believe the IRS is up the amount from $17,500 from last year to $18,000 this year that you can put away for your 401k or
right. And that's per person per year, right?
I believe it is.
Right. And we can ask Kim if we're not sure next week.
Right.
So obviously, if you have an employer and you are, and they give you matching funds for like a 401k type of a plan, take full advantage of that, and put the maximum amount in you can that they'll match always. It's like getting a pay raise instantaneously.
It is. It's a great thing. And Roths are a wonderful tool. And they, again, the limits this year, I believe, are $5,500 that each individual can contribute. So if you're married and you can put in two $5,500
Right, that's $11,000, but that's only assuming that you are under a certain income. It's one of those things, if you're over a certain income, they don't allow you to put funds directly into a Roth.
But Kim will talk about a way, and one of those is that you can put it into a traditional IRA, and then you can roll it into a Roth. So that was a really good tip that she shared with me, that based on your income, if you don't make the income requirements, that you still can contribute to a Roth.
Right, because we didn't meet those requirements and we wanted to contribute this year, and they said, well, there is a way you can do it, but you kind of have to take advantage of a loophole in the law. So really good to know about that. But anyway, once you get your retirement, you start funding that. We start looking at other mandatory expenses that we're going to have in the future. If we have kids, we want to put a significant amount towards their college. We can recommend 15%, but really that's an individual choice. It depends on where your kid wants to go to college and how much time you have and things like that. You're just going to have to kind of estimate what's going to cost for college and housing, and kind of divide it out to how many years you have.
Right. I mean, I think maybe a good way to kind of tell that is if you look at your state university and see what the rates are going for there. That can give you obviously a good idea of what. I mean, it really is between probably $30,000 and $50,000 a year for that.
Right, and of course we always want to avoid student loans if we can.
Yes, absolutely.
Right, that's just putting a drag on the kid. So once you get going, then you start saving as much as possible towards the purchase of a home. If you don't have one, if you do have a home, I like to see people at least. I mean, ideally you wouldn't have a mortgage, but I can see the argument for some people who have significant assets that a 3% home mortgage for 30 years on a fixed rate, that's a pretty low rate. So I can see an argument for not paying that off. I mean, Sherry and I sometimes disagree with that, but I know Sheila says no debt, pay that house down, and we've paid our house down. However, if you're that type of person, I urge you to at least pay your mortgage down at 50% loan to value. And the reason I say that is because you have credit ratings, and you want to have some sort of a security, and if everything goes to hell and you lose your income, and the stock market crashes and the real estate market crashes like in 2008, and we get into a situation where, hey, I can't pay my mortgage anymore, and you have to sell your house. If you had 100% or an 80% mortgage on that thing, you're not going to be able to sell that house. Because you can't pay your loan off. So that puts you into a situation where you have to go into a bankruptcy situation, or you have to go into a short sale, which is going to be very damaging to your credit, and it's going to take a long time to repair that. If you're 50% loan to value, there's a really good chance you could just sell that thing, and get out from underneath it, and move on. So that's why we kind of come up with that number.
Yeah, and hopefully you'll have a little bit extra to kind of whatever your next step is to go towards that next step. So
right. We don't like to think of it, but it does happen.
It does,
so
unfortunately.
Need to be, and this is just just common sense being prepared. So from there, we're just going to kind of talk about risk assets and stages of risk assets and stuff like that, right? So you're going to have your emergency fund, and I just want to again, your home and your emergency fund, they're not risk assets. These are something that you should have liquid, that's generally in cash. I mean, your home, you shouldn't be borrowing on your home to put it in the stock market. Very, very bad idea. It's just not a good thing to do.
Right. You don't want to risk where you live, so because you want to go home.
Right, and then we have retirement accounts. So your home should be in essentially a cash equivalent, nice safe thing for your emergency fund. If you're borrowing funds from your home, they should be in safe assets. As far as retirement accounts go, you can start to take risk on retirement accounts. Now, the amount of risk you want to take on retirement accounts, it does really vary for everybody. It's going to be dependent on your age. It's going to be dependent on your risk tolerance. Usually, I mean, of course, you can be very aggressive when you're young. When you get older and you reach retirement age, you want to be much more conservative with that.
Except in 2008.
Yeah, except in 2008. Well, actually, some people made a lot of money in 2008.
I'm sure they did. Yeah. Unfortunately, that wasn't the case.
Yeah, for most people, it wasn't the case. Another good risk asset to have is real estate, other than your primary residence. It is, you know, it is a risk asset. Especially if it's not very risky per se if you don't owe anything on it. If you do owe a lot of money on that real estate and you don't have a big emergency fund or money put aside, you have repairs you need to do, you have extensive vacancies, that can be a challenge. So you possibly lose the property.
Well, you want to prepare for that. So you
Right.
want to have, again, I recommend 6 months of expenses in an account to, if something happened with that particular piece of property, that you needed to wait to fill the vacancy so that you weren't obviously desperate to do that. So that you make a good choice as opposed to a desperate choice.
Right, right. And then once you have, I mean, you have that, you have your retirement accounts, you have your emergency fund and everything, and you have enough money for other stuff, then you can come in and you can start really getting aggressive with your portfolio, and you can start looking at stuff like, you know, I don't know if your dream fund, I call it, you know, whether it's a dream business purchase, if you want to do trading for a living, which is essentially starting a business. You know, toys you might want, exotic vacations, just to have extra cash. You know, if you're investing, you should be, you know, giving a charity, but a charity above and beyond what you would normally do, if that's that's what you'd like to go towards. And like I said, these are funds for more aggressive investing. So moving on, I just want to talk about the security allocation. The emergency fund and saving for necessities, right? All this stuff should be in cash equivalent investments, whether it be a cash thing, a money market account. If you try to get a little bit more, I mean, you can look at CDs, but this shouldn't be in anything risky. If you want to try a little bit more, they do have these things called market-linked CDs that are often principal protected, but not all the time. So if you want to, you know, bump your rate from, I don't know, a CD probably pays like 2% now, which is crazy, and I think that would be a super high-paying one. If you get into a market-linked CD, you can get up maybe into the 3 or 4% range, where if the market performs well, you'll actually do significantly better. If it doesn't perform well, you should have principal protected CDs.
So the market, sorry, I'm going to ask a question.
Oh, yeah,
the market-linked CDs, they're locked in though, right, for a period of time?
Yeah, you have to tie your money up. Yeah, so you don't want really an emergency fund in there so much, but if you're saving for college and you know the date at which you're going to need it,
that makes sense.
Or if you're saving for, you know, certain things where you have an idea when the date's going to be and you can lock up that money, then certainly you can at least bump it a little bit with something like that.
Right.
Okay.
Oh, I just wanted to mention, if you have questions, please feel free to ask them and just type them in the questions box. I forgot to go over that at the beginning of the, the talk. So
okay, great.
if you have questions.
So if we can get into slightly more risky stuff as well, I don't necessarily recommend these. I just kind of want you to know that they are available. I mean, one of the things is structured notes. You can get into banks where they will provide these things called structured notes, and they'll give you often a fairly decent return. I mean, sometimes 4% or so. Excuse me. However, there's two things you need to know about. They tend to be a little bit illiquid if you want to get out, and they are subject to bank failure, but it is a way to get you know, a higher rate with some of your money that might be, you might want to put a little bit more risk to it. I mean, generally, if you pick a good bank, it's not going to fail, but that's not, as we found out in 2008, that's not necessarily the case, because structured notes, unlike a CD, they're not FDIC insured. So if you do have a bank failure, you may not recover the cost from them, but they are an option. And another thing that we like to talk about is annuities. And you know, annuities have a very bad rap, and I tend to agree with that. You know, there's a lot of life insurance annuities out there. They're just really a bad investment. They're riddled with fees, and they're terrible, terrible, terrible. However, there are other annuities that are available out there that have very low fees or no fees, and they return very good. I mean, 6, sometimes more %. You can get them so they're linked to the stock market. I mean, you can get you know, bonds that will return, you know, like a guaranteed 6%, for example, and then if the stock market does well, I mean, you could do 7, 8, or 9%, or sometimes 12%. And the good thing about annuities, if you pick the right one, again, they're not all principal protected, but there are a lot of them out there that are principal protected. So you can be guaranteed 6%, market crashes, you still get your 6%, or maybe depending on the product you get, I mean, maybe you might not get a gain, but you're principal protected, so you don't have to worry about that. Again, there is risks to this, and the risks is you're investing essentially in an insurance company, and if we get an insurance company failure, again, which is not FDIC insured, then you could be out your principal, but in general you won't be. Also, again, so you have to really check out the companies, and I lost my train of thought there. You want to make sure you avoid the fees. Usually in annuities, insurance companies are typically, they do have insurance. They don't have FDIC insurance, but usually they will have some sort of a belong in some sort of a state insurance program. So you want to just check with the state, make sure, figure out what type of insurance that cover in case the company goes under. Tony Robbins, which I don't know if you know him or not. I mean, he's a very popular motivational speaker, and he's been a mentor of mine in one form or another for a long time. He just wrote a book called Money. Sorry, let me get the name. Money Master the Game, and he has worked with some of the most wealthy people in the world and the best investors in the world. And we're going to be talking about some of this other stuff when we go into a little bit more risk management. But he's worked with some of, like I said, the best investors in the world and richest people, and asked them, what do you do with your money? And he's put together programs, actually, that used to be only available to really, really wealthy people, and now it kind of brings them down to a level of that most people can afford. So one of the programs he put together with one of the life insurance companies is www.lifetimeincome.com. And if you're interested in annuities, you can go there. They have this little evaluation thing that's kind of neat, and then you can talk to a salesperson if you're interested in something like that. But that's a really cool thing.
It sounds really neat. I haven't read the book yet, but I would like to. I think that it sounds like it's got a lot to offer.
Yeah, it's typical Tony Robbins, which is actually very, very good. He does talk a lot about stories and rambles off sometimes, but he's fantastic, and he has a lot of super information. So highly recommend that. So once we get to that, your low-risk stuff or your cash equivalents, we get to moderate to high-risk investments, right? And again, it's going to depend on age and risk tolerance. And we have some people who can risk anything, and we have other people who are willing to risk anything.
Well, some people can afford to.
Well, some people, yeah, right. Some people can't afford to, and some people can't.
Right.
And that's 100% true, and that's part of it too. So what you're going to do is going to be dependent on your risk tolerance. But some of the higher risk or moderate risk things are stocks, real estate, bonds, commodities, and gold. Now, if we want to, well, did you have anything to say about the prior slide, or are you good?
No, I'm good. Go ahead.
Oh,
Keep
okay.
going.
That's
You're on
good.
a roll. You're on a roll.
So I'm going to talk about this in the context of the average person or the average investor. And this isn't, I know some people on here are actually investors, or they play the stock market and stuff. But from an average point of view, when we talk about doing investing, a lot of people like to play, or they think they're going to play individual stocks, and they're going to make a ton of money doing that. I mean, and generally, an average investor is not going to make money playing direction in the market. They're typically going to lose money. So you should probably stay with some things that are more traditional. Now, in average, one of the things that is in Tony Robbins' Master the Game, Money Master the Game, is he talked to this guy, Ray Dalio, who is arguably the best investor in the world, and he essentially asked him, he says, what would, he goes, first of all, how do you manage your money? And he says, well, it's way too complicated for anybody to understand, and I agree, it's probably right. If he's making that money, if he's that good, he's doing things that general people aren't going to understand. But then he asked him, he said, well, what would you do if you couldn't trade anymore, and you left all this money to your daughter, and she knew nothing about the stock market? What would you do to, where would you tell her to put her money? And this is essentially what he came up with. He says he'd go 40% in long-term U.S. bonds, 30% in index-based products, such as small caps or large caps, or basically index-based funds. 15% in intermediate-term bonds, 7.5% commodity, 7.5% gold. And the idea of that was to diversify among a bunch of different things. And, a lot of times the stock market goes up, the bonds go down, the bonds go up, the stock market goes down. Usually if the bonds in, the stock market goes down, commodities and gold go up. So commodities and gold being the most volatile, we have the smallest percent in that. Long-term U.S. bonds being the least volatile, we have the biggest percent in that. And the theory is that the portfolio balances out over time. And they back-tested this portfolio for many, many years. And Tony Robbins has a team of people who did that, and very, very good results. I mean, for passive income, right? Because you're just giving somebody your money. And he teamed up with this company called Stronghold Financial, www.strongholdfinancial.com. They call us an all-seasons portfolio. And if you want to have somebody else manage your money, I'm looking at it from my point of view. It looks logical, but Ray Dalio is a whole lot smarter than I am when it comes to this type of stuff. And they'll do an analysis of your investments, and then you can go into something like this. I mean, one of the things you got to watch when you're in mutual funds or fees and stuff like that. So this is low, very, very low fee, so you get most of your returns back and stuff like that. So it's really, really cool.
Sounds like a good option.
Yeah, it is a good option. And if you don't like that option and you want to do self-investment, well, certainly you can do all this stuff on your own if you're a trader. But
let's just say you're an investor who doesn't want to watch it, doesn't
right.
really want to manage it yourself. And so this would be a good option for that.
Yeah, this would be a really good option for something like that.
Okay.
Right.
And what is did you get a return on it?
You know what? I don't remember, but I think over like a 20-year period, they had an average return in the 10% range, which is really, really good. But the good part is they really didn't have any significant losses. I think they had 2008 was a loss because the market was straight down, but it was only like 3 or 4%. And I believe actually 2013 was a loss because the market was straight up. Right, so whenever you hedge stuff like that, you get that. But pretty much everything else was very, very consistent, very, very consistent in the returns category, which is really cool. And then they have this other guy called David Swenson, who is also a very, very good trader. And this is the diversification that he recommends. Right, it's 20% of stock index fund. Notice we're always saying index funds. 20% in an international index fund, 10% in an emerging markets index fund. To get your real estate exposure, you go into real estate investment trusts, 20% there, and then you have your inflation protection with your tips, and your long-term treasury. So that's another suggested mix that they have. So I'm just kind of throwing that out there. And okay, so that's for that stuff. So let's talk about the average investor, actually almost any investor in stocks. Trading individual stocks is a high-risk game, right? And I can tell you from a lot of research and a lot of experience with lots and lots of traders that more than 95% of traders, including trained traders, lose money over time playing individual stocks. And in addition, the risk is huge. You don't want to come in and put half your net worth in a couple of stocks. It's just a foolish thing to do. Now, if you're a really, really good trader and you're a good directional trader, then that's your business and you have a proven track record, and then you start doing that, then you can do a little bit more. But essentially, if you're the regular guy and you're going to bet on directional stocks anyway, I would recommend only money that you put in your high-risk basket.
Yes, because that's where your eggs are.
Right, your eggs in your basket. So you take money in your high-risk basket and you pay with a maximum 2% of your net worth, and you can play whatever you want with the markets because you can afford to do it.
It sounds like gambling. It sounds like fun, though.
It is. Yeah, well, it's fun. I mean, like I said, I'm all for having fun. I mean, if you have the money, you can go buy a fancy car and play around. But if you don't, if you're scraping by, you don't do that.
That's true.
Right. So you don't want to play individual stocks with money that you don't have.
True.
But for the most of us, let's start talking about some asset allocation. So whether we're trading on our own or whatever, these are more get into my recommendations as a non-professional financial advisor, right? So I can't really make recommendations to you, but this was what I would do if I had a limited amount of knowledge about trading. I would suggest that you can put about 40% of your net worth into mutual funds or ETFs or index funds, right? I never recommend doing individual stocks unless it's play money. The reality is that an index-based mutual fund or an index-based trading or ETF is going to outperform probably 98% of active traders, right? First of all, a lot of active traders don't even make money, and even if they do, they very, very seldom outperform the S&P 500. Therefore, you're actually better off to park your money in the S&P 500 and walk away. And most people will make more money. If you're going to do something like that, then I would suggest you put 40% of that in something like the S&P 500, which is a wide-based index, or some other. I mean, you could put it in the Qs or something like that. Well, not the Qs. I'm sorry, but the Dow diamonds, or something like that. And then I'd put maybe 40% in small caps, because they usually tend to perform a little bit better, and then probably 20% in emerging markets, and that's a very good mix. My only exception to this is if we have experienced traders with a proven track record. I mean, if you're an experienced trader, you have a proven track record doing this, and you're going to make trading your business, then I would start with up to 20% of my net worth. Not necessarily start with 20%, but I would start up to 20% of my net worth. And then, normally if you have a high-performing investment and you put 20% of your net worth in it and it does well, it's going to become a bigger part of your net worth, right? And then what most people are going to do is they're going to rebalance their portfolio. So if they had $1 million and they put $200,000 in the stock market and it grew to $400,000, they take that extra $200,000 out and put it in a protected thing and remain trading with 20%. But what I'm saying is, if you've proven to yourself by producing that own money with stock market returns and you're just simply reinvesting the money, I'd probably be willing to scale up to almost 60% of my net worth doing that. Right? So I start with whatever amount. I build myself up to 20% of my net worth. I build my trading account, and I don't take it out. I just keep building it and building it and building it until it's 60% of my net worth, and I would go that far. If I was over that, I'd probably want to diversify a little bit and start pulling out. But those are my general thoughts on that, and that's how when we train traders, that's how we do that. Publicly, I never say more than 20% usually, and I'd say that's probably good for most. I know, and I would encourage you not to do that. And when I say that you have a proven track record, if you have 20% of your net worth and you've built yourself all from just trading up to 60%. You're a pretty darn good trader, right? You've made a lot of money. So
we all aspire to be there.
Right. We all aspire to be there, as they say.
Real estate, my favorite.
Real estate, right? Again, if you're real estate, I mean, up to 40% of your net worth, if you have a propensity to do that and you like residential real estate and stuff, I mean, 40% of your net worth into real estate is a really good idea. It helps diversify yourself, and it can be income producing, whether it's residential
Definitely
or
want it to be income producing.
Commercial property. That would be very good. If you're not comfortable with renting things out and you don't want to deal with management hassles, I mean, you have real estate investment trusts and REOCs that you can.
And property managers.
Can do that, or you can hire property managers. Yeah, if you're doing well. Of course, you always want to make sure you understand how to actually manage the properties. Always. But you definitely can do that. And of course, if you're a professional level, like we just talked about a professional level trader, if you're a professional level real estate person, I mean, up to 60% of your net worth in real estate is good too. We don't want it to go more than that, because sometimes just like the stock market, you can be a really good trader, but you can have a couple really bad years. Same thing with real estate. We can have some sort of a market crash. We can have things happen.
Oh, yeah.
And you do want some diversification.
Absolutely.
So that's with that. And then other things with risk stuff is going to be gold, bonds, and commodities. Right now, this is not my area of expertise. I don't invest in gold. I don't invest in commodities, and I do not do bonds. I'm just going by what the experts tell me here, and they basically say that to have up to 7.5% of your investment basket, right? This is not your net worth anymore, but this is about 7.5% of your investment basket in maybe some sort of a gold portfolio to help protect against major things. It just kind of takes the edge off a little bit. If you had the gold in 2008, the initial drop, real estate dropped, bonds dropped, stocks dropped, gold shot up, right? That's only during the original, and a lot of the commodities shot up, but that was only during the original drop, right? After the original drop, so you had a really steep drop in 2008, gold commodities, and some commodities shot up, and then the market leveled off, and the gold and commodities started coming down, right? And then they lost a lot of their value, and then everything went up. But it did kind of take the edge off of the initial drop. And it helped diversify us a little bit. So, if you want to do that, that's up to you.
All right. We're going to go to our allocation.
Right, and then we talk about our allocation, right? And this, a lot of people ask me, how I allocate my money. I don't do, like I said, bonds. I don't do gold, but I am into, real estate, and obviously I'm a trader. Even as good as I am being an educator and all that other stuff, I only have 20% of my net worth in my trading strategies, and I'm able to actually produce good income off of that. But realistically, I just reinvest it. We don't even touch that money. We just reinvest it. But I do overall have 40% in the stock market. We actually have 20% approximately of our net worth in index-based. Index-based funds, right, and we have some in small cap and some in the S&P 500 based index, and those are going to perform how they're going to perform, and my trading strategies are typically going to perform very well, so that balances out and gives us a good thing. And then I have another big chunk. I have about 40% of our net worth in rental real estate and homes. And that diversifies that off, and then maybe 10% of my business, and basically just other businesses and stuff that we have going on, and then about 10% of it is in just cash laying around. So that's a decent mix for us. So we're at the end. Oh my goodness! So this is our information, and again, next week, this is for our blogs, and I do post daily during the weekdays to the blog, so you can find us there. And if you have any questions, you can send the questions to questions@financialfreedomclassroom.com, because next week we have Kim Landry, a very good friend of ours, who is going to come and talk to us about taxes. So if you have any, I'm gathering questions for her to present next week. So if you have any tax questions that you want to ask, please feel free to send those along. We're very fortunate to have her. She is she's very. Well, she's not your regular accountant
No.
that just says, "Here, give me my form and I'm going to fill you out."
Yeah.
She's just very conscious about really digging in and doing what she needs to do to do whatever she can to take advantage of any edge.
She likes to think outside the box.
Proactive, as you say.
Yeah, she's excellent. We're very fortunate that she's coming. So hopefully I'll get some more questions. We'll get it all together, and then she will be on next week, and we'll have at 7:30 Eastern Standard Time. And we'd like to thank you for joining us this evening.
Yeah, thank you very much, and hope you join us next week.
Goodbye, everybody. Take care.